Matthew Johnson's with us, Johnson Wealth Management, Income Management. Good to see you, Matthew. Your thoughts on the markets?
Did I just hear you say that people are willing to take on more risk right now? Is that what I heard you say, Nicole?
That's what I'm hearing. I mean, that's what I'm hearing. New highs last week, right?
Okay, well, I might be the dissenter in this group because as in times past in interviews, and thanks for having me back on again. It's always a blessing to be on here. But the reality is that I think that some of us are starting to get a little worn thin on this continued increase in interest rates. The reality is that if we study history, Nicole, the track record of the Federal Reserve is not all that great. If we go back to, say, World War II, and we study World War II basically from that point forward, and we extrapolate out the cycles in which we had inflation that was at 5% or above, after the rate hikes, they have a 100% success rate of a recession taking place. And this is the concern that I have for a lot of people. We're starting to, we're seeing the numbers coming in, and I think it's definitely time for a respite. And yet, I don't know. I'm looking at this Federal Reserve and I'm scratching my head and saying, why do they continue to keep nailing these nails into the coffin? Just give it a break and let the economy do what it's naturally going to do, because we all kind of understand it takes time from what happens in Washington to what actually takes place in Main Street.
Right. And so, look, you have also sometimes they say that Wall Street and Main Street are not necessarily on the same page. What would you say?
I would say that that's a kind of a foregone conclusion. That's absolutely true in many respects. It depends upon the area of the country that you're in. But we understand why the Federal Reserve has been doing what they have been doing, okay? And no one's faulting them for that. But just think about how they were pitching this to us for the longest time, and that was the fact that they wanted a soft landing. Well, it feels like they continue to drive interest rates up, which continues to drive the economy into more of a shrinkage mode. It's like they're trying to land the plane, but they don't even have the landing gear out yet. And so the sentiment here is that we have to be very careful to understand that there is potentially some volatility on the horizon that we need to be very careful with. Now, I don't know if the Feds are going to be dogmatic or gutsy enough to raise interest rates again in September, but I really hope that this last July rate increase wasn't going to be the thing that pushes us just right over that proverbial cliff, because I think this is when people can become kind of blasé. Maybe they're taking a few steps away from their portfolio. They're not really paying attention. They're on vacation with their family. And this is when things tend to go awry. And we're looking at data that came out just today. And what are we seeing that's happening to orders? We're seeing that manufacturers are seeing no longer such a big backlog of orders. And we have to take that into consideration. What does that mean for the rest of what we're going to be seeing happening in the next 6 months of the year?
So you talked about onward and upward for the Feds hammering the nails in the economic coffin and basically saying, look, they're willing to do this again. Historically, they've done this. They can take the economy down. Do you see a repeat happening?
If they go ahead and they raise interest rates again in September, I absolutely do. And I don't want to say that. I'm not trying to be a pessimist here, but the reality is that their track record shows that they continually have this propensity to overcorrect. And when you overcorrect and you don't give the economy enough time to just kind of digest what's going on and naturally calm down, which we've been seeing. And I suppose that there could be those proponents out there, Nicole, that say, listen, the reason that we're seeing that is because the Federal Reserve has done what they've done. And I agree with that to some extent. But do we want to continue to push this envelope, or is it time to just back off a little bit and let the natural order of things take place? That's what I'm arguing for. Of course, I'm not a big enough cheese that they would listen to me, but the reality is that I think investors today, especially retirees, have to be very, very careful because they're optimistic. Think about it. Their balances have come back, right? They're within 4% or so of the previous high of 21. Are they going to be susceptible to that of another drawdown?
And so at this point now, as you're handling wealth and income management for folks, you're feeling a little cautious. There are folks who want maybe a barbell approach where they take more risk on one side and a little less on the other. What are your strategies at this time based on what you're seeing?
Well, I'm so glad you asked that, because the majority of the people that I serve are going to be 55 and over. They're going to be retired. And if we think about it, you know, many of today's financial advisors, Nicole, are trying to derive income from a growth-based portfolio. I believe that that is a very serious mistake for people that need income because they are retired or they're nearing retirement. So, you know, I've said it before and I'm going to say it again. One of the positives of what the Federal Reserve has been doing is it's creating absolute fire sales for fixed income. And, you know, most of us would just kill to have 5% in appreciation on our portfolio. Well, think about what if at least half of your portfolio was producing 5 or 6% in interest and dividends. And so this is about two things. It's about reducing your risk to principally protect what you've got on the board. Okay. If you just got done getting it back, keep it. Keep those points on the board. And number two, this is about taking the wealth that you do have and getting it to work for you to produce a consistent income of interest and dividends every single month that you can count on. And this is going to be very important because with the economic cycles, you and I, we're not big enough to control those things. But we have control on our money and what our money does for us. And so we need to be very objective, very purposeful, and we need to be focusing on those dividends and those interest dollars coming to us.
Matthew Johnson, great to see you. Thank you very much. President, owner of Johnson Wealth and Income Management.